Good afternoon now. Good afternoon now. Good afternoon. So, I think today's this session's topic is impact of the revised credit guidelines of RBI on commodity finance. We are happy to have a distinguished panel of Bharat, and particularly happy that we also have a farmers spokesperson and an academician, and of course other senior bankers. Now, just to give a small introduction, why practicing guidelines of RBI are considered to be very important. First thing is, it determines the access to finance. Second, it also determines the cost of funding. Many banks are prepared to give fund at base rate without any margin if it happens to be PLR based lending. Sorry, is that prior to sector lending. So, Reserve Bank during the last July 15 guidelines have brought about, I would call it a revolutionary change in terms of supporting private sector capital formation in the scientific storage space by enhancing the limits up to 100 crores. Anybody from the banking system, the collective loans from the banking system does not exceed 100 crores, it can be still covered under the private sector loans. Second, up to 50 lakhs in the case of farmers and also in the case of traders, up to 50 lakhs, up to 12 months, it is considered for private sector coverage. Third, in the case of cooperatives, it goes up to even 5 crores. The key issues which are to be discussed, I would also request the panelists to maybe apart from that thoughts, maybe a few key issues they would like to dwell upon would be what are the, in the context of the revised practice and the guidelines, how do we take care of the level of volumes of commodity finance which we expect in the medium term? It is going to be 35,000 crores now. Maybe it may be touching about 1 lakh crores in 2-3 years' time. How do we take care of that? Number two, how do we ensure a level playing field for traders or commodity managers? Okay. I think there is an increasing voice, I think, which will also be expressed during the course of the day, that 50 lakhs is a severe restriction from the commodity managers, funding point of view, especially from the traders' point of view. Third, how do we, mainstream FPOs and aggregators of small farmers and marginal farmers so that they take maximum advantage of the relaxation which is given in the private sector guidelines. Given this context, whether the current private sector guidelines are good enough to put a way forward for a robust commodity financing environment. If not, what should be the way forward for a policy? What should be the way forward? What should be the policy feedback for Reserve Bank of India for revising its guidelines? I think with these few words, I would like to leave it open to the floor. First of all, let me introduce my my panelists. Mr. Prashant Shah, by my left is Prashant Shah from Axis Bank, Narendranath Mishra from DCP Bank, and the right, Professor Ramakumar from TIS, who has done I was told, maybe you would like to speak 1 minute on that, the kind of presentation we made to Rural Finance to, the governor, okay. And Mr. Chattanathan from Axis Bank, and also Mr. Jakhar. I particularly, especially welcome you because you are the farmers representative. We keep meeting all the time. Okay. So now I think that first I would request Mr. Ajay Jakhar, representing Bharat, Krishak, Samaj, to say a few words.
A very good morning.
Yeah, making it this is a 5 minutes per person.
I'll take 2 minutes extra, so let me start and then we'll decide. First of all, let me just say that it's a great honor to be here and to be speaking to an audience which has someone like I would consider my mentor, Y.K. Alaksa. It's a real pleasure being here. Sir, before I start, you said speak in 5 minutes. There are a lot of disagreements I have with the first panel. And with the second panel, I start with a disagreement of 5 minutes for the only farmer in the room. So I'll take 1 or 2 minutes extra. When farmers start, they don't stop easily. That you would know. Struggle over how losses and gains from state action are allocated in the farming sector is what is termed as food politics. Consumers want low prices, farmers want high prices, and how the government decides that balance is what is food politics. And agriculture credit is one part of it. I will also, sir, without your permission, not speak on the topic of agriculture credit because Ramakumar ji is there, and in his presence it makes no sense that I talk on a topic on which he is an expert. But what is commodity finance? Commodity finance is basically financing for speculation, if not gambling. It is financing for storage of commodities. And as a farmer, I will say this is not wrong. I'm not trying to say something that, I'm not trying to accuse anyone of anything, but this is exactly what it is, and we must have clarity on that. For many years, Chinese banks financed commodities in China, and that was one of the reasons why commodity prices went up since 2002. Around 3-4 years ago, around 2013, the Chinese government told the institutions not to finance agriculture commodities, and it's also one of the reasons why agriculture prices in the international market have come down. Also, what has happened is, when prices went up, farmers responded to market signals from Canada to Argentina to Australia and even in India, and production went up. When prices have come down, farmers will not be able to respond as quickly and production will remain high. And simultaneously, what will also happen is that the stocks that have been accumulated over the last few years are not going to get diluted in the next 2 years. So as a farmer, I think we are in a stage of food deflation, not in food inflation. We were the only farmers organization to talk about food deflation for 5 years, and every economist, barring Alaksa, actually laughed at us and told us that while the Indian government is trying to focus on food inflation, you're talking about food deflation. And we face it across the world. Even FAO has agreed to our propagation and advocacy. Now, you could say that there is inflation in price of pulses, but that's not because farmers cannot produce it. That is because of government policy. And that's where some of the contradictions that I'm going to be talking about arise from here. First of all, we come to cooperative banks, because I think for agriculture credit, cooperative banks are necessary. Cooperative banks are in desperate need of capital adequacy ratio funding. The central government does not give it. The central government gives it to the public sector banks. If I'm mistaken, please correct me, because government has infused capital into public sector banks, but it does not infuse capital into cooperative banks. Are public sector banks too big to fail and cooperative banks too small to do away with? Because public sector banks will never be able to get us. The government tried to use public sector banks, they will not be able to get credit to the small and marginal farmers. It will not work in the way it has been working. Also, when cooperative banks take finance from NABARD, refinance, when cooperatives take refinance for the loans from NABARD, it is not applicable for subvention, if that's also true. So these are structural issues that need to be taken care of. Agriculture commodities, financing post-harvest is very important. In fact, we realize how important it is. The RBI governor and the RBI called us for interaction on agriculture credit just 2 weeks ago. And what Bharat Krishak Samaj did is that we took all representatives of the value chain of agriculture credit from the secretary of a primary agriculture society to a commodities company representative to talk about issues they have at their level. So we absolutely understand the need of having post-harvest credit. But credit, sir, that Jinnah sir that you've talked about of 8.5 lakh crore rupees, less said the better about it. And I hope Ramakumar ji will elaborate on why farmers would disagree with all those figures. I've jotted down a few points while being sitting here, and I can also warn public sector banks and financial institutions that over 60% of farmers, that 60% less farmers will be repaying their loans and interests this year because of the crisis we face. Now, also, Jinnah sahab, you said that monsoons, money lenders and markets are responsible for agriculture distress. Sir, I also disagree with that. I think so it's only government policy which is responsible for farmer distress. And I will give you an example of that. Every time, see, in every commodity, everyone here basically deals with commodity. It's only once every few years that a price of one commodity increases. And for the rest of the years it remains low. But when the price increases, the government enforces a ban. It did it with wheat in 2007. For 4 years, the price in the international market was approximately $440, which was over 60% of the domestic price. We were not allowed to export. The government did it with non-basmati rice for 3-4 years. Till 2011 they did it, while the price in the international market was 160% of what it was in India. When it came to cotton, there's farmer suicides in Vidarbha, in Maharashtra, in all the dryland areas today, where people grow cotton, it was mentioned. Why was it? Because the textile ministry controls the cotton advisory board. Cotton is taken as an input for the industry, not as an agriculture commodity. The notification was changed 17 times in 18 months. Nowhere in the world, not even in a banana republic, something like that would be allowed. But that is what had happened. The price came down from 7,000 to 4,000 and farmers are committing suicide. So that's how agriculture distress comes from it. When onion prices rise, onion imports are allowed. When pulses rise, imports are allowed. So what happens when you import pulses? You're actually subsidizing farmers in Africa. You're not subsidizing. You could have easily given a higher price to Indian farmers. You could have enabled it, and those subsidies, whatever you may call it financing, you may call it higher prices or whatever, but that extra money, instead of paying to farmers in African countries, you could have paid it to farmers in India. And that's what creates a problem of credit. We export, we give incentives to rice, we give incentives to sugarcane, which are water-consuming crops, and we import pulses, which is a rain-fed crop. And those incentives come in forms of sugarcane mills, sugar mills being given interest subventions, being given interest waiver and things like that. It absolutely makes no sense. We export soybean as animal feed and we import proteins. This is the state of government policy. These things are important. October 16th is celebrated as World Food Day. I was invited to be a panelist with, I think, 30 agriculture ministers in Milan at the Milan Expo 2015. I absolutely refused. I prefer to be with farmers in Bhubaneswar because there's nothing to celebrate. After 70 years, nearly 70 years of independence, the government is still trying to feed farmers cheap food. Where in the world would you feed producers food? I mean, it's a policy. So how it has happened is that first the government decided that we'd have a food security bill. So I'm not against everyone having cheap food to eat, but there's another way to reach the mountain. There are many ways to reach the mountaintop, and the way that the government has chosen is wrong. So we decided to build a huge stockpile of food, which anyway, the interest burden of that stockpile itself is 20,000 crore rupees per year. So we created a huge stockpile. To create that huge stockpile, we banned export of food grains. Simultaneously, we gave jobs under NAREGA, which increased the price of producing food in the second place. So, instead of allowing farmers realize a better market price by allowing exports, we could have taxed those exports. Government could have got revenue from that and invested that in agriculture infrastructure. But rather than doing that, the government decided to ban exports. And they banned exports because they wanted to build a a stockpile, and they wanted to build a stockpile because they wanted to feed cheap food. Instead of wasting all that money and opportunity, farmers could easily have had a better price. What would farmers do with that kind of money? They would not go buy cars or homes or anything. First thing a farmer does is he repays his loan. It may be to a money lender, it may be to a bank. It is a great illusion that farmers don't repay loans when compared to industry. The industry has a debt recovery tribunal which waives more than what farmers get once in 10 years. It waives more than that every year. So how you word it, terminology becomes very important. How do you word farm waiver, farm loan waiver? Because this is to do with interest. So if farmers had made money, we wouldn't be on the farms suffering today, and we would not, the banks would not be suffering, and they would have more money to lend to commodity firms, and they would have more money to lend to other people. So there are issues like that. Commodity derivatives, I don't think so will help in price discovery to the extent that they will claim to help us find a better price. Look what happened in forward market. Look what happened in NCDX about guar prices. When guar prices rose up, how was financing and how were markets used? I mean, did it lead to a price discovery? And that's why regulation becomes very, 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 very important. Now, RBI has removed the differentiation between direct and indirect loans. And I think that's not a good step. Of course, the RBI has done something good also. They have said that 8% of the loans will go to will be small loans given to farmers. But just because you allow something good doesn't mean you take away something. I think so that should have remained, because most of the direct finance that is supposed to go to farmers is not going to farmers anyway. And so I think this differentiation should have remained. One of the prerequisites for commodity finance to work, for direct benefit transfers to work, for data collection, for insurance to work is collecting and analyzing data. And till we don't spend money in collecting data, which specifically includes land ownership and tenancy records, every policy of the government that is proposing is not going to work, is not going to succeed. And that is the crucial thing, because even if you want to give finance, you will have to give it through land documentation. It becomes a prerequisite of getting that thing, because when you talk about post-harvest credit, I agree it is much less compared to pre-harvest credit, and all the problems that farmers face today is basically on post-harvest credit, post-harvest rather than trying to cultivate a crop. So it becomes important. But if we were to believe that there would be a trickle down, that large companies would take credit from banks, would take refinance from NABARD or in any way, and that benefit would trickle down to farmers, it's not necessary, because speculation would feed into it. So till you don't go to the bottom of the pyramid and finance that small farmer's ability to use better technology, it is not going to happen. And it's not that finance is not available. Irrigated farmers have very easy access to finance, and they suffer because of that. In fact, we told to the RBI governor also 2 weeks ago that we are against subvention to farmers, because it is not serving the purpose it is supposed to serve. Farmers in irrigated areas take multiple loans from multiple banks and societies, and they make fixed deposits out of it. So they get money at 3%, they make a fixed deposit at 7%. So that is one side. But 60% of India, which is rain-fed, don't even have access to credit. So when you talk about credit, when you talk about financing commodities, how do you build an equity where the benefits spread to society? That is a question that you have to answer. And I think so till the commodities markets, till commodity companies don't self-regulate, you will always face opposition from the rest of the nation. And that's something that you have to understand, because regulation itself cannot happen the way it is. Pravesh Sharma ji, I don't know if he's here, but Pravesh Sharma ji said that I'm not a small farmer, so at least I thought I was not a small farmer. I went to Ukraine a month ago to speak on large management farms, and the question I asked is, what is a small farmer and what is a large farmer? And they said 12,500 acres. Anybody who owns less than 12,500 acres in Ukraine is a small farmer. And I told them there's not one large farmer in the whole country today.
Mr. Jakhar, it's a little 10 minutes now.
I'll just take last thing. So one thing that is required for commodity financing to work and for the commodity markets to work is standardization of products. What I'm saying is the terms differ. You might say this is one quality in one market, might be a different quality in one market. In Amsterdam, you have the largest flower auction market in the world. 60% of the flowers are auctioned there. I've gone and seen it myself. And in that auction market, all the flowers are auctioned on computer screens. Nobody sees the product. Till we don't come to that kind of a standardization across India, commodity business is not going to reach its full potential. So I really would urge all the commodity traders and businessmen here to work on standardization first and look for financing later. That needs to work. Without that, your trade will get hampered. Thank you so much for your time and patience, sir.
For a fair description of unfair deal performance, I think some of the issues which I've noted down will sum it up in this thing. Only one or two things I want to clarify. That there has been a capital infusion from the corporate banks by way of Professor Vaidyanathan committee recommendations. Around 28,000 crores has already been floated, just for one. Secondly, inter-subvention is available, even NABARD refinance there. There's a small formula which is being worked on. Okay, fine, okay. Now, yeah. Okay, fine. Let's now hear Mr. Narendranath Mishra from DCB Bank.
Good afternoon. I first of all think that the RBI guideline which has come recently, US guideline, is actually a very revolutionary step. There are three key positives in that. One is that the entire agri ecosystem's need is addressed because the money which is given to the agri ancillary sectors, which is food and processing, is also coming under agriculture. Unless the food processing and ancillary industries improve, we cannot improve the farmers. So these are all interrelated. Second is that it brings on focus on the small and marginal farmers. The speakers before me has already spoken about that there are something around 14 crore small farmers. So RBI's specific direction that part of these finances, which is 7% for the year, has to go for small and marginal farmers, will definitely keep a focus in this segment from the banking sector. Lastly, there was a lot of confusion: what is direct, what is indirect. Like part of corporate lending is direct. If it's beyond certain limit, is indirect. All those are removed. So the guideline is very simple and very easy to also understand and implement. Coming back to the commodity-based finance issues, it is not the private sector guideline which is actually the issue. Sometimes we actually confuse that credit is the only solution to meeting the farmer's need. Credit is just one of the subset of the farmer's needs. And in my view, it is a very small subset. What prices the farmer is getting the input, what prices the farmer is selling, how he is able to sell, what is the infrastructure support like warehousing available, all those determine the final benefit the farmer gets. And lending is also one part of it. So coming back to the warehouse financing for farmers. Now supposing there is a farmer who has only 4 acres of land. He needs a financing of 1 lakh rupees only. Now to finance on 1 lakh rupees, supposing you are raising a warehouse receipt, the collateral management cost of raising a receipt with the emblem, then managing it is quite high. It is not viable to actually fund small farmers unless they come in groups like speakers have spoken about producer companies, about farmer groups, or about an ecosystem where actually a lot of farmers come and take finance against warehouse receipts. Unless that happens, it is very difficult to finance individual farmers in warehouses because the cost just doesn't permit. Today from a banking sector, if you open one location, it costs around 4 lakh rupees per annum. So unless a location carries 3-4 crore kind of funding, it is not at all viable. So unless it is commercially viable, if not profitable, this finance cannot be scaled up. Second issue which is there in the farmers is that today, if you see the price fluctuations which has happened over the last 1 year, is something which is very abnormal, very abrupt. Because of globalization, what happens in China, that determines the prices of cotton in India. Earlier, there was a trend in commodity price. At the time of harvesting, the price used to be low. That is not necessarily true now. Now, does the small farmer understand the price movements? Does he want to take a risk? Because by selling his produce, he is getting the money immediately. By taking a finance, its cost is increasing. There is a warehousing cost, there is a finance cost. So I feel that whenever we are trying to promote to the farmers, small farmers say that I don't understand the pricing, I want to sell my produce and I want to pay my debt. So many cases the small, so how do we actually engage them and bring into the system? Is it possible to bring a insurance kind of product where this entire things can be congregated? Like today we have crop insurance, but which can be hedging, but can a small farmer who has 1 lakh worth of commodities, can he go and hedge actually commodities? Or is there any support which can be available to the farmer that in case they make a loss, that loss will be taken care of by government or by some subsidized means? Then only the farmer will come. I am talking about particularly about small and marginal farmers. And as Mr. Jakhar was saying, the large farmers have been taking commodity-based finance earlier also. Even in current scenario also, they will be taking. And the processors are already coming under agriculture, so for them getting commodity-based finance will not be a problem. The problem area is actually particularly for the small and marginal farmers, the farmers who own less than 5 acres. How do you have an ecosystem where the collateral management cost can be substantially brought down by technology? I have met some collateral managers who are talking about that today our collateral management is based on human intervention. Like there are guards, there are warehouse managers. Can it move to a surveillance system where actually technology takes care of the warehousing surveillance and it is centrally, there is some alarm system by which the stock is taken care of so that the collateral management cost go down. We all know that the collateral managers don't make much money in this business because the manpower cost is so high. So the collateral management cost goes down. And there is more warehousing with what our Mr. Jinnah was mentioning about 14,000 crores worth of warehousing has been brought in by NABARD in the last 5 years. So I mean there are more warehouses which is used to PPP or to state government intervention which are close to the farmer's place, combined with a low collateral management cost and with an insurance cover which takes care part of the hedge, or there is some subsidy to the farmer in case the commodity prices goes down. If this entire ecosystem we can bring in with a very positive private sector guideline, I think this finance to the small and marginal farmers, particularly in place finance, can increase substantially. And regarding the other segments, I am not focusing because I believe that largely the large farmers and the processors are getting a benefit of this guideline. Thank you.
Thank you, Dr. Jinnah. I must thank Star Agri for inviting me to make this short presentation. I would apologize to you if I sound like a contrarian at the outset itself, because I'm not very sure whether my views will be in conformity with the consensus view that appears to be there in the audience. My first point is the following, that there is a very strong relationship between, and I would like to concur with Ajay here, that there is a very strong relationship between the health of the pre-harvest economy and the post-harvest economy. You cannot have a crisis-ridden pre-harvest economy and a flourishing post-harvest economy. And that's the very important point that we all have to take as a premise. And that directly takes me to the issue that Parvesh Sharma mentioned in his introductory speech, which is that of rural finance. And I see commodity finance as being embedded in the larger question of how you structure your rural financial institutions. What are the major issues that we have here? And I want to make this opening remark that the particular way in which we have handled the question of financial liberalization in India in the last 20 years has been left unproblematized in India. We take it as a given that the kind of financial liberalization that we have seen in the last 20 years in India, beginning from the Narendranath report in 1991, has been taken as a given. It's taken as something which is unproblematic. And it is hardly noticed that the process of liberalization that we have had in the last 20 years has reversed many gains that we have had after 1969 when we nationalized our banking system. And that's a very important point. And I would like to substantiate this argument with a few following points. If you look at Indian agriculture in the last 20 years, there has been a significant growth of technological potential in the agrarian economy. Technologies have flourished, both in the private private sector, of course, it has come up very strongly, but just look at the way in which we have disincentivized the small and marginal farmers from taking advantage of these technologies. I'm coming to rural banking, which is the central part of my presentation, but take a very small example. BT cotton was raised as an issue in the last session. Have we handled BT cotton economy properly? Look at across the world, successful cotton growers like China, even Pakistan, grow 95% of their cotton as public BT varieties produced by the public sector. We in India take pride in the fact that 95% of our BT cotton, or cotton, which is BT cotton, is actually private hybrid. Not public variety, but private hybrid. Is that the way to run a BT cotton economy? Why has it been that we have not encouraged in the public sector? We have the Central Institute of Cotton Research in Nagpur, which produces a variety called Bikaneri Nirma BT, BNBT, which is a straight variety of BT cotton, which produces as much as other private hybrids produce, but we have to hardly encourage the technology. Both are BT. There's a particular way in which we have handled technological growth. Technology is important, but have we incentivized the small and marginal farmer to adopt it? Has our public policy been in conformity with this goal? We have not questioned that process at all. Now, coming to there are other issues. For example, we consider computerization of land records as a less important initiative than tom-tomming this initiative called Aadhaar, which is actually a solution in search of a problem, in my view. It's a highly problematic technology, but we think that simple question of computerization of land records is unimportant, and something like Aadhaar is more important. There is a problem in our prioritization in handling our agrarian economy. Now, coming to rural finance, what is the problem at hand here? Well, the problem at hand here is that we have clearly moved from a low input, low output economy to a high input, high output economy in agriculture, which has raised costs in agriculture because of a particular subsidy regime. Costs of cultivation have gone up and output prices have not been commensurate in their rise. As a result, what has happened is risks in agriculture have significantly grown. And do we have a mechanism to help our small and marginal farmers to cope with this risk? Is our rural finance robust enough to provide the farmers with support and assistance in coping with this high-risk new economy in agriculture, which includes the BT cotton problem that I just mentioned. Now, here is where I would like to argue that the nature of financial liberalization that we have had in the last 20 years has made banks fall back in their target, in their responsibility, social responsibility of supporting this agrarian economy. Now, let me keep this 2-3 data points on the table. I think I have 2-3 minutes left in my allotment. The government collects data on rural finance through its every 10-year All India Debt and Investment Survey. Take 2 data points, 1992 and 2013, which covers the 20 years of financial liberalization in India. Take cultivator households, rural cultivator households. The share of cultivator households who were indebted was 26% in 1992, which was 46% in 2013, with 20 percentage point rise. That's not a bad thing, because financial inclusion is not necessarily a bad thing. It can actually be good. But the point is, if you look at the debt asset ratios of cultivator households from the same survey, take the debt assets ratio, which is actually how much is debt a drain on your asset. If you look at that debt asset ratio, it was 1.6 in 1992, which has risen to 2.5 in 2013, 1.6 to 2.5. So you have actually an intensification of the debt burden of cultivator households, which has accompanied this rise of indebtedness of cultivator households. That's the second point. But there's one more data point. Where is this increased indebtedness coming from? What is the source of loan for these farmers? If you look at cultivator households again, The share of debt outstanding from the informal sector was 30% in 1992, which is now something like 36 to 37%, which has risen in the last 20 years. If you look at money lenders alone, money lenders contributed 18%, 1/8, to the total debt portfolio in 1992. They today contribute 30%, 18 to 30%. I'm not going into how interest rates have also risen in this process in the last 20 years. This is what I'm saying. Has financial liberalization served the needs of farmers? Have we problematized the way in which we have handled financial liberalization in our country? No. And that's the question I would like to raise in this session. And the question of priority sector guidelines is not an abstract which is hanging there, which is actually, and I see it as deeply embedded in this problem of rural credit in India. It is not to be seen as separate, as something which we can discuss in an abstract sense without looking at the larger question of the agrarian economy. I'll give you one more point, which is that in the last 20 years, there have been two phases. One between 92 and around 2004, when rural credit actually dried up significantly for farmers. And you will see a second phase, post-2003-04 phase, where actually you see a huge revival of agricultural credit in India. So there are clearly two phases in this period of financial liberalization. A period of which I call as a lost decade of rural finance in India, the 1990s, and a revival phase in the 2000s, particularly after 2003. Between 95 and 2005, you have actually something like 1,000 rural bank branches closing down. But between 2006 and 2012, you actually see 5,662 new rural bank branches being opened. That's a very important factor of the revival after 2004. 5,600 new rural bank branches of commercial banks. If in 2004, 96,000 crore went to agriculture as credit, in 2013, 10 years time, 96,000 crore goes up to something like 6,76,000 crore. That's an enormous expansion. So the second phase of financial liberalization, you actually do see an expansion of rural bank branches and an expansion of amount of agricultural credit given to rural areas. In other words, between 2004 and 13, rural agricultural credit rose by something, rose by 5,79,000 crore in India. That's a huge expansion. But why are then farmers complaining? But then why is it that AIDIS data, which is considered very robust, is not showing that the amount that farmers obtain from commercial banks is not rising, and that from money lenders is actually rising? In other words, where is this credit going? And that's where I want to point out this point about commodity finance. That's where commodity finance comes in a big way. Let me give you one more number and end my presentation. My point is, this is not going to farmers. This has not gone to farmers. The point is that much of this increase of rural credit, agricultural credit, keep making that mistake. Agricultural credit is actually going as indirect finance. Number one. Number two, if you take the size of loans, and if I take rupees 2 lakh of the size of the loan as a cutoff, 5-acre sugarcane farmer in Maharashtra gets 1.9 lakh, which is the credit limit given by Maharashtra District Cooperative Bank. So less than 2 lakh is something that we can see as going to the farmer. So if I take the cutoff as less than 2 lakh and more than 2 lakh, the amount of total agricultural credit that falls in this category of less than 2 lakh in size was something like 92% in 1990 when financial liberalization began, but now it's only 48%. Only 48% of the total agricultural credit that we give out today is of the size less than rupees 2 lakh. 52% is more than rupees 2 lakh. Number one. In other words, if I superimpose this number on the total agricultural credit that is going to India, went to India in 2013, which is something like 6,76,000 crore, something like 3,56,000 crore actually went to non-farmers. Was commodity finance. In other words, enormous amounts of credit are being given out to the private sector, in the post-harvest sector, in the name of agricultural credit, and that amounts to something like rupees 3,50,000 every year. A large part of it is commodity finance. Large part of it is commodity. It's not going to farmers. One more example I'll give you. Something like 30% of the total direct agricultural finance that we give out in India is actually from urban and metropolitan branches of banks. 55% of the total direct agricultural credit in West Bengal, 55% of the total direct agricultural credit, not indirect, direct agricultural credit in West Bengal goes from urban and metropolitan branches. Who is getting this? Have we set this problem right? We have said that we have seen agricultural credit is growing. Very good, but where is it going? It's not clear. Now, that clearly brings me to the question where I want to end my presentation, that I want to concur with Ajay, what Ajay said, that the removal of distinction between direct and indirect finance has actually led us to a very strange, by the way, it has not been removed. By the way, it has not been removed. The RBI is in a state of utter confusion in this regard. It had an April circular. RBI, in an April circular, removed the distinction, which was after a task force of the RBI internally suggested that kind of change. But in the July or August, I forget, there's another master circular in July or August, where they have actually brought back the direct-indirect distinction and have asked banks to concentrate more on direct finance in an interesting way. So the distinction has not gone. RBI is in an utter state of confusion in this regard. It's not clear what they're going to arrive at in the end. This priority sector guidelines, in some sense, unfortunately, legitimizes credit given to corporate sector as credit given to farmers. I'm not against credit being given to corporate sector in any form, but that should not be at the cost of credit that should legitimately go to the farmer of India. That has to be seen as distinct source of credit for the corporate sector. I will end my presentation here. Thank you.
Some correlation between 2003, you said there was a spurt. This also coincides with the doubling of agriculture credit growth. There's a policy which that is very clear. And NABARD has conducted our own studies saying that, in your own state, Kerala, and Tamil Nadu, my own state, Kerala, 80% of the agriculture crop loans are gold loans. Gold loans. There is one reason, this kind of a one-to-one correlation between agriculture credit and crop production is not happening. Okay. Now, as far as there is no confusion in the minds of RBI and NABARD, we had a lot of internal discussions. We had a discussion with the Finance Ministry of DFS, and we took a very conscious decision saying that this has to be revisited for the time being. Okay. There is no confusion. Okay. With this few words, I would request Mr. Prashant Shah, Axis Bank, to share his thoughts.
Yeah, I prefer to sit over here to discuss on this. See, being a part of the first panel discussion, we always end up hijacking the elements of discussions of the other panel discussions. I'm seeing some people striking off their notes here. This has been discussed about. So let me stick to the agenda of correlating the pain areas that was given by Mr. Sharma with the PSL guidelines and come to the commodity funding part of it. So the pain areas that was given by Mr. Sharma was lack of innovation, right? The first part, which I feel, looking at the digital way how banking has been done nowadays, and the new innovations that are coming up in rural marketing. In fact, what you rightly said, Ravi, is now it's not no more agri-lending. Now we are talking of rural lending also. So Axis Bank is changed their agri-lending to rural lending. Financing to farmers is not necessary only financing the crop loans. And as you rightly said, it's not necessary the cultivation part of the activity. Also the post-harvest, which ideally goes to the private sector, which indirectly comes to the farmers again, which doesn't happen as per what you're saying. The PSL guidelines are very clear pertaining to a pain area of small and marginal farmers. They have clearly mentioned that 7% has to go towards it. So I know lots of other banks have already developed their products based on that. Now when we have a government body and farmer representatives over here, we really have to play a diplomatic role as a banker, because we are the actual implementers of of the policies, with also a fact of earning profits. So we have to also keep this thing in mind. The third one was human labor, which was the pain area echoed by you. I also agree with that. The ancillary activities and the infrastructure of the PSL guidelines takes care of it. So from the policy part, the PSL guidelines are bang to what is been required to be done. The problem lies in implementing it. So if I talk of a scenario or talk of a case study wherein I fund an oil mill to a group of farmers in a village for a post-harvest activity as done for an SFAC, and I have a situation where I have 300 such oil mills, and these oil mills will generate that oil, and I have a collection system of the oil, and I have a refining unit sponsored by a public or a government agency. Whether this will work? We always talk of experiences or examples of a florist in California or a winery in France, but Dr. Curie, he cracked this code. Milk being the most unorganized sector, the main key is not creating warehouses in the villages. The main key is developing the logistics for collecting these activities. This is the main problem area what I feel in the overall PSL guideline, wherein we have never emphasized on developing the logistics of delivering the material of the farmers or processing the material at their own end and proceeding further. So if we implement the milk replica to the oil mills, I think the whole oilseed industry will be taken care of. Right? They have a very detailed Amul had tried this once, but it failed. E-Chopal was one of the concepts that started by ITC. That also has not been picked up very properly because, as you rightly said, of not having a robust government policy, because they end up having MSP guidelines coming up at the last moment or a stock restriction coming at the last moment. Coming to the commodity part, we are saying we have done 30,000 crores of commodity, but only 10% goes to farmers. That is a fact. I go with Narendra on his point of view that a farmer having 2 lakh rupees of 1 lakh rupees of produce, does it really make sense for that person to arrange for a transportation of his own, take a trolley, go to the warehouse, arrange for a warehouse receipt? Does he have a wherewithal or a knowledge for doing that? No, he doesn't have it. The SFAC, producer farmers, yes, the conceptually things are working on very well. We had a department in Axis Bank only to take care of the producer companies, but the registration process of the producer companies was really made it very difficult for us to get our farmers implemented. And the farmers end up dropping off afterwards. The reason why this is happening and the reason why Dr. Curie cracked this code is because they didn't treated farmers as a helpless old man sitting in the field with a stick in his hand. They treated farmers as entrepreneurs. They treated farmers as businessmen. And Amul is not at all started with a profit-making initiative. Not at all started with a social service activity. It was initiated by a profit motive, wherein the farmers realized that there is some sense of, and the housewives, basically, the people who are the ladies who are taking care of the buffaloes and cows. So the reasons for this whole problem, what I feel is the awareness, which I feel for commodity funding people are aware. Intention, it really makes sense because they're getting a price discovery out of it. Infrastructure, as spoken by Mr. Jinnah, creating warehouses at village levels, I really doubt it. Does it really make sense? Because now when we have, Flipkart doing 30% of its business in rural India, and if I create warehouses in the village levels and the farmers end up stocking it, somewhere that the commodity will need to be shifted to a processing unit. So towards step delivery of finance is one of the key issues which I feel as bankers we can really resolve it very easily. Keeping the digital technology in mind, wherein I can have RML, for example, Lotus Markets. If you look at the way these sparrows are growing up, we have farmers who are tracking up their prices of even vegetables and fruits in that app, and smartphones have reached the rural market like, there's nobody who's using a normal old Nokia nowadays. So yes, as a banker, we can think of a doorstep delivery of finance, wherein I can give an app to a farmer and he can opt for it. It has already implemented it in lots of locations. MFI has already cracked that code where, they go with a tab and they have the village survey and do a CFC, HSC and all these concepts. For commodity, the last point which none of us have talked about is to give an exit guidance to the farmers. When is it that the farmer should get out of that commodity or we should make him greedy? I fund the primary market, I fund the secondary market, I fund the farmers, and by the way, in the PSL guideline, traders are not at all a part of it. I hope that 50 lakh rupees is only for the farmers and it is only for the processing units. No traders are there. As a concept, yes, Pangrain has started this in Punjab since last 2 years, wherein they wanted to remove the Arthia concept from the whole farming community, but it is practically not possible now because there is a political intervention between it where there is a lobbying taking care of it. Price fluctuations, I feel the price fluctuation is more of a cartel business done by a few people, which happened in cotton bales, for example, which has resulted into this escalation of prices. Farmers are not getting benefited out of it. I absolutely agree on that. Financing of speculations, I don't agree with that option because I really don't think so. Price discovery is the main motto, and if as a banker I stick to the harvesting cycle and a 3 months, 4 months period for giving finance, this speculative financing will be dropped off. So that is what is my view, and we can debate it afterwards on that. Thank you.
Thank you, Prashant. I will request Mr. Chattanathan from ICICI Bank to set the thoughts.
I think a lot of discussions have happened around policy initiatives, thoughts in terms of economy and other things. So it has been an intellectual stimulation throughout the day, I would say. So I'm not going to comment on any of those because some divergent views have come. I would like to restrict myself to the core subject of priority sector and commodity finance together. Whether it was at the right direction which RBI gave in dispensing direct and indirect and merging it as one. Second is to see that whether commodity finance is a right alternative strategy for business as a whole, how this business is going to emerge in the overall spectrum. First thing which I just want to put a perspective is that when we say commodity finance, we are not restricting our thought processes only to farmers. We are talking about a value chain finance. So we are talking about farmers, we are talking about traders, we are talking about processors, and we are talking about exporters. Was this funding been there earlier in the years pre-thought process of actually originating this sort of finance? Now, in that context, whether the circular has enabled a better methodology of promoting commodity finance, my view is yes, because it has merged all the processing segments into actually the agricultural finance. Now, RBI, what was the main principle of actually merging this? I do not know the RBI's mindset, but I would like to just put my views to say that unless and until the economy is integrated, we probably would be trying to see more and more crop loans going into the banking system. We were talking about a 7 lakh number which is being talked about. I think NABARD, Jinnah sir will ultimately at some point of time say that the credit flow to the investment has come down. So whether it is actually culminated into a co-bundling of investment and production credit together which has given this rise to 7 lakh crores, we do not know, because it's very difficult to assess once the money has moved out, a similar asset whether it has got created or not. The other point, Mr. Ramakumar was saying that there are a lot of bookings which have happened in the urban, semi-urban areas, whereas the farmers are actually in the rural segments. I would like to just address that point, because somewhere over a period of time, centralization of banking systems have happened. So today, futuristically, do I really look into a brick and mortar model, or do I move into a centralized model with digitalization happening in, correct? there could be situations which will emerge in that a branch is there. For example, if a new private sector bank is starting with just about 25 branches, say they still want to actually go and lend in the rural areas. The entire booking which will be there as far as the advances is concerned will be in those 25 branches, which need not necessarily be rural branches. Because we were, at some point of time, ICICI Bank was also a part of it. If you look at 2003, 2004, when we had lesser number of branches, the entire business of farm finance was looked and booked in only one branch. So, technically I am operating from all across the country, but pooling of that asset is happening because I am boarding it in the system. While delivery is happening at the field level, boarding is happening in one system. So this may continue to emerge as a system which will have diversifications. So this data which we are talking about, whether 32%, 40% has happened from the urban, semi-urban centers, need debate. I am not saying wrong has happened or right, but as I said in the statement itself, I am not going to delve into any political issues here. Now the circular directionally is moving in two directions. One is to say, do I need to create processing and storage infrastructure? Yes. On the other hand, a large farmer over a period of time has been in a position to get access to credit in a better way. Hence, as all of you were concurring, saying that the segment which has been left out, where we do not have a right and proper access, is the small and marginal farmer. Hence, with respect to the circular, I feel it has tried to address the chain in the best way possible, because it has tried to converge both the processing entry and the segment which is not having access to credit, that is small and marginal farmers. So you have put a blank to say that can the banking system move towards 8% in the next 2 years, because 7 is key, this year it's been said, and 8% lending towards small and marginal farmers. That's the way the circular has directionally focused to say. At the same time, it has put one more restrictions. Can large guys like Hindustan Livers or Tatas can borrow funds because they require thousands of crores? RBI has been selective. A guy who is having the banking system in the processing unit not exceeding 100 crores in the banking system. Now that 100 is debatable, correct, whether 100 is right or 50 is right. But directionally, I think what RBI has tried to do is that I will put priorities or levers on to push the small and marginal farmers up, because these are the ones who are not getting direct access to credit. And I create infrastructure because Sharma sir said that we have about 900 million metric tons. Government is addressing a space of about 60-65 million metric tons of space. Now look about the things. Grain storage, when we talk about, we are talking about various statistics are there, right one I do not know. We talk about 110 million metric tons of space. Out of that, we are saying food security occupies 65 million metric tons of space. We talk about 265 million metric tons of grains getting produced. Now, storage will be dirt. There could be instances like, for example, places like in MP, where probably storage surplus is there. But across the country, when we talk about, the storage is going to be one of the actually structures where needs to be built in. One hand is that. Second, let's look at the population rise and the storage. Now we are talking about 125 crores. 4 decades down the lane, we will be about 250 crores of population in the country. There probably we will stagnate with the current birth rate and death rate. Now we are talking about some amount of change in the food consumption patterns. We see that horticulture productions have increased. So we were talking about how the shift has happened from almost 75% that side to this side. But still grain will be consumed unless and until probably some research comes in and we say that we produce tablets which will give nutrients which will suppress hunger. So this production has to continue. From whatever we are talking about 265, my belief is that at least it has to translate to somewhere around 400-500 million metric tons in the next 2 to 3 decades. So we are talking about a storage structure which is about 110 million metric tons of space today. Out of this, currently for the levels of population which we have, we are talking about 65 million metric tons to be occupied by the government. So if this population raises, if this food security bill needs to continue, whether it has to continue, not continue, I am not getting into it. Assuming that the policies remain the same and we continue with the food security, the current level of space which is available in the country will be fully occupied by the government. So to that extent, where the Reserve Bank has given the right direction to say that agri infrastructure, whichever you are getting created, which was a part of indirect agri, moving into direct agri, I feel it's a right direction because storage infrastructure has to be created. Now, I'll come to the last because the dearth of time will be there. I can keep on going on speaking about it. Now let's look at the value chain now, where all RBI has tried to do interventions. One, we are saying, and how I'll try to correlate why commodity-based finance is slightly a better structure compared to the others. Now let us look at it, 7 to 8% we are talking about the small and marginal farmers. Sir, you have done a great job in the last 5 years. I think segmentally, directionally, this is the way we need to go. Because unless and until aggregation happens, small and marginal farmers would not be in a position to actually get any benefit, because 1 lakh, as many of our colleagues have said, I'm not getting into it, smaller level transactions will not get any incremental additional benefit, because when we talk about 10% increase or 12% increase on a 1 lakh value, it is not significantly large as far as the money is concerned, because on first hand he is getting the entire 1 lakh on cash hand, he is not taking any storage risk, he is not taking any price risk. Without taking anything, he is in a position to get a lakh of rupees. So by storage, if you feel that next 6 months the increase is going to be just about 15-20%, administering some 10% or 11% increase plus the storage cost, this is not going to be significantly large. But when it gets aggregated at a FPO level or any other aggregation model, it comes in handy, because that is where the bankers can step in. My view is that in the next 4 or 5 years, the quantum of lending which will go through the FPOs would be substantial. At this point of time when we are talking about, it looks to be minuscule, but directionally this is the way the country has to move in. Now we were talking about 1,000 FPOs. My view is that n number of FPOs will start happening in the country, because banking system will move towards or push the system to create FPOs. That's the way I am putting it in. Then coming to a pre-production loan vis-a-vis a post-production loan, purely from a banker's perspective, it becomes much more sense to say that I am having access to the commodity, hence lending to the commodity is much better. So purely from a small and marginal farmers directive, if you ask me personally whether I would like to go for a pre-production loan or a post-production loan, as a banker it gives me a lot. I'm not getting into the debate of access to credit. I'm only putting a banker's perspective to say that whether I want to go and give a crop finance to a small and marginal farmer, or a production finance, or a produce finance, the tendency for me to move towards a produce finance will be far higher compared to a crop finance. Now, when it comes to that, can I go and build models around FPOs to say that it addresses the system? RBI has given a beautiful claim for us. Now it says that all FPO lending which you are doing, if it's 75% of members in FPO are small and marginal farmers, I can tag myself to that 7-8% which is required. So it's a beautiful incentive which has been given by Reserve Bank of India to address the needs of small and marginal farmers. And in that, I would say that for me, the post-production loan is actually much more risk-free compared to a pre-production loan. So to that extent, I am linking that whether commodity finance will move in this direction, it will move in this direction. So I am leaving farmer for a moment aside. Now let's look at the trader and the processing segment. As Sir RBI has removed the trader segment, because that 50 lakhs it prescribes is that one who's engaged a corporate, a partnership firm, a cooperative society engaged in farming. Under that it says if it is having 50 lakhs. So trader does not come as a part of agriculture, but we tend to give, because it is under MSME, it comes under priority sector. So trader gets access to finance. The two segments which they have removed from the classification perspective is that fertilizer dealers, which used to form a significant portion as far as the indirect agri is concerned, because somewhere at some point of time Reserve Bank felt that fertilizer dealer is a fulcrum for agriculture, hence access to that was given. In the current circular that has been removed out. So probably access to the fertilizers dealers in terms of credit needs have been met, and hence it has been removed. So as a priority sector it will still form, because he is a trader, he will fall under MSME, so he will still get under priority sector ambit. Now I'm just coming to commodity based finance. Again withdrawing myself and say, as a banker now, do I want to ask him to give his house, his balance sheet to be good, his ratios to be good in this segment? Probably no, because all those financials which will come in will not fall beyond BB minus, max to max. And I'm giving a best case scenario of BB minus in terms of rating. Now, how do I mitigate my risk for funding to those segments? Instead of asking security, instead of asking balance sheet, can I ask the guy who give me commodity, put it in a warehouse which is accredited? Then it makes much sense for me to actually go and lend to that guy. To that extent, whether this has been addressed in the current circular, my belief is yes, because it forms a part of MSME. Now, agro-processing as a segment has been brought into agriculture. So, to that extent, wherever agro-processors are there, access to them by way of commodity finance will be much easier, because the financial ratios which you look into when you are funding against commodities will be far, I would say, lower compared to a straight balance sheet lending which you are giving. So positionally, my belief is that this business has to grow. Currently, we were talking about 35,000 crores of disbursements, but my belief is that the book outstanding would be somewhere between 20,000-25,000 crores. 35,000 crores could be disbursements because we do it in 2 seasons. Now, this can it go to 1 lakh crore? My belief is a strong guess. Somewhere, this percentage of lending to farmers, which are currently at about 10%, because of the directions which RBI has given, saying that you need to fund to an extent of 8% to small and marginal farmers, a lot of FPO lending in this segment will start happening. 3 years, 4 years down the lane, if we see the movement which will happen with respect to commodity finance, which we are talking about farmers getting about 10%, and here also when I am talking about 10%, majorly it will be large farmers. It's not small farmers, because somewhere we need to get to that right segment. We are saying that today it's large farmers, so it will move towards FPOs, and not saying lending to small and marginal farmers directly in this segment will happen. So it will be either to cooperative societies or to the FPOs. The composition will get changed because of this direction which the Reserve Bank has given. Today we are talking about 10% going to the farmers. My belief is that this will move to around 20-25% in the next 2 to 3 years. And predominantly this, which is at about almost, I would say, 0.5% to 1% small and marginal farmers in this segment, this would move or translate itself to about 10%. I'm purely talking from the commodity finance perspective alone. This is just an estimate which I'm trying to give. I do not have data rationale to prove how things are going to happen. But when I see this environment, this is the way things are moving ahead. This is all from my end. I think already you are signaling the time. Thanks everybody.
Thank you, Mr. Samaj. Maybe looking at the clock, I think we should close. We can take only 2 questions from the floor. Professor? 3.
I'm a little confused. Can I just pose a problem? I mean, agro-processing is important. All the other sectors are very important. Trade is important. You know, if you look at, we had a 14% fall in the profitability of agriculture in the first decade of this century. Then for a few years, agriculture maintained its step. But during the last 3 years, since as a very young man, I was chairman of the Agricultural Prices Commission. So one of my ill-gotten gains is I get their draft reports. During the last 3 years, the terms of trade have moved against agriculture by 4 percentage points, which means to me it's the major explanation of the low growth of agriculture of around 1 to 2%. So how, that issue is not being addressed at all in commodity financing. How do you support the farmer? If you don't do it, the rest of it is all on very shaky grounds. Or is that not a matter of concern?
So I think,
I'm not, believe me, not any individual speaker.
no, nothing.
But
I'm just trying to address this. We felt that currently the discussion which we are doing at this point of time is to see that whether the guidelines give growth to the commodity finance per se. So we have not addressed the issue to say whether directionally credit has to go into that segment or not. Banks are individually, and the Reserve Bank is also following it up. As I was telling, I think Ram had pointed out, Reserve Bank has come with a guideline after the issuance of the circular, saying that they still, I think the number is yet to come. Reserve Bank has given a circular saying that while indirect dispensation has been removed out, they have also given a guideline to say that they are going to come with the last 3 years averages of direct flow of credit in the banking system. So we need to meet that as a sub-target itself. So it's not that direct-indirect has gone off fully. After the issuance of the master circular, where this direct and indirect got merged, there was one more circular issued by Reserve Bank of India saying that in order to see that directionally the credit flow to the farmers is happening, last 3 years average whatever banking industry has done as a directional flow to the farmers, that number will come from Reserve Bank of India, and that also has to be met as a sub-target. So to that extent, our discussions today revolved around, as I said, because The segment was commodity-based finance. We revolved our discussions only to the extent of how the industry of commodity-based finance will move from X to Y. On the other hand, banks are still given directions to give crop loans, KCC, because we are evaluated based on the amount of KCC issued. Similarly, that number which has been put in, till now I think banking industry, public sector banks are slightly better paced with respect to small and marginal farmers. I think they come to around 5.6%. Whereas we see all new private sector banks will be about 1%. So technically, if I have to move the small and marginal farmers from 1% to about 7% and next year 8%, it's going to be a significantly large task and directional flow of credit to small and marginal farmers. And that can't happen in commodity finance, because commodity finance can have a growth of 20%, 30%. If I am saying 20% growth will be there from commodity finance, in that I am having only 10% as farmers, 1% as farmer financing and as small and marginal farmers. So this 7-8% which has to go to small and marginal farmers will have to necessarily go towards pre-production.
Why do you distinguish between commodity finance and financing the producer?
I couldn't understand your question, sir.
No, see, we are sort of separating trade and processing from the producer in this entire discussion.
No, because that forms a segment, correct sir? Today, directionally, the credit flow which has to happen will happen to all these segments. So in a value chain, each of these guys require the respective working capital. So a processor requires a working capital. So today, his working capital needs are getting met by two ways. One, if the balance sheet is strong, through a balance sheet mechanism where he doesn't offer any security. So to that extent, when the finance is there, the working capital finance which is on the balance sheet, which I was telling to you was, will move towards a commodity finance.
So,
Mr. Jinnah?
We will, yeah.
We have time for one more question. Request you to keep your question short.
Sure. So with the revised PSL guideline now...
Can you tell us who you are as well so we can address you?
Yeah, myself is Ashish Kumar. I am working with L&T Finance. So with the revised PSL guidelines now, RBI has introduced, well-defined this small and marginal farmer. But somehow this revised guideline is silent on the other part, which so-called large farmer, which again, as Mr. Ajay was telling, it's a debatable large farmer. So now this large farmer is at par with corporates who are seeking a finance up to, let's say, 100 crore or so. So I personally feel with this revised PSL guidelines, somehow this large farmer, who is also a large grower, large producer, large feeder, may be overlooked while accessing to the financial community. I would like to have views of bankers, if I can.
It's a comment, question.
It was not based to me, but I'll be happy to answer it. How do you define a small farm? That's the question. Go to the root cause of it. I'll tell you what happens with banks actually. Jo sab yahan bola hua hai, sab theek hai, but I'll tell you what happens in the village. When a person goes to take a loan, he has to give documents to get that loan. The cost of taking that loan, forget the interest cost and the bribes or anything, I'm not talking of any of that stuff. I'm just saying the cost of taking that loan is something like 10%, the documentation cost. As a part of that documentation, you have to give your land documents. Based on those land documents, you get classified as a small farmer or a large farmer. So farmers will never get all their land documents for taking that loan. So if somebody owns 10 acres, which becomes a large farmer in India, he will, if he wants a loan and the limit is 1 lakh rupees per acre, he will give documents for only 2 acres, and the bank will classify it as a small farmer, even though the bank knows he owns 10 acres of land. So if you listen to public sector banks and they say we are lending to small farmers, I absolutely disagree with that, and that is why I'm saying land records are necessary. And that is why also at the discussion with the RBI governor, the question came up is, can we link the Kisan credit card to a system where loans are only given, one loan of a farmer is classified as a Kisan credit card loan or ready for subvention. So their root causes, you have to go back right to the end. Otherwise, you're always you're trying to mitigate the consequence of a problem. You're never solving the problem.
Over to you, Mr. Jinnah.
Yeah. So, thank you, panelists, for the excellent presentations. I think as a chairman, you have to ensure unity and diversity, which is difficult. But if I have to say in one word, one sentence, it would be in good direction, but not so good delivery. Okay. I think there is a kind of this thing which has come out. There are a few thoughts which has been shared to ensure fair amount of equity of access to the small and marginal farmers, which as RBI has already ensured in terms of the latest circular dated July 15th, which has again reintroduced direct and indirect finance. Plus, they've also introduced this thing of 8%. Flow should go to SF and MF. Second, the question which has been raised by some of the panelists, especially Axis Bank, our Prashant Das, is that the delivery, like the courier model of accessing the, courier code. Okay. So can we do that? I think landscape is changing. The small payment banks are coming. The small finance banks are coming. The technology giants like Reliance and the technology, the systemically important banks, the State Bank of India, holding hands, and then it should change in the near future. With this few words, I think I must close because the moderator is looking at me. Okay.
Yes,
Thank
I'm
you.
sorry, that is my unpleasant job, like I said.
Thank you.
Very